Welcome to our video on personal finance tips and advice for a better financial future. Personal finance is an important aspect of our daily lives, and managing our finances can help us achieve financial stability and long-term financial goals. Create a budget and stick to it. One of the most important things you can do for your personal finance is to create a budget. A budget is a plan for how you will spend your money. Start by tracking your expenses for a month and categorizing them. Then, create a budget that reflects your income and expenses. Make sure to account for savings and debt payments in your budget. Stick to your budget as closely as possible to avoid overspending and accumulating debt. Example, let's say your monthly income is $4,000. After tracking your expenses for a month, you find that your expenses total $3,500. You can allocate the remaining $500 towards your savings or debt payments.
Build an emergency fund. An emergency fund is money set aside to cover unexpected expenses, such as car repairs or medical bills. Aim to save 3 to 6 months' worth of living expenses in your emergency fund. This will help you avoid going into debt when an unexpected expense arises. Example, let's say your monthly living expenses are $2,500. To build a 6-month emergency fund, you would need to save $15,000.
To avoid paying more in interest, prioritize paying off high-interest debt as quickly as possible. Consider consolidating debt or negotiating a lower interest rate with your creditors. Example, let's say you have $10,000 in credit card debt with an interest rate of 18%. If you make only the minimum payment each month, it will take over 20 years to pay off the debt, and you will pay over $17,000 in interest. If you increase your payments to $500 per month, you can pay off the debt in less than 3 years and save over $14,000 in interest. Maximize your retirement savings. Start saving for retirement as early as possible and contribute as much as you can to your retirement accounts, such as a 401k or IRA. Take advantage of employer matching contributions and consider increasing your contributions each year. Example, let's say you are 30 years old and want to retire at 65. If you start saving $500 per month in a retirement account with an average annual return of 7%, you could have over $1 million saved for retirement by age 65. Investing wisely is an important part of personal finance management. Investing can help you grow your wealth and achieve long-term financial goals, such as retirement or buying a home. However, investing can also be risky, so it is important to approach it with caution and make informed decisions. Here are some tips to help you invest wisely. Start with a plan. Before you start investing, define your financial goals, risk tolerance, and investment time horizon. This will help you choose the right investments and create a portfolio that aligns with your goals. Diversify your portfolio. Diversification is the key to reducing risk in your investment portfolio. Spread your investments across different asset classes, such as stocks, bonds, and real estate, and within each asset class, choose investments with different risk levels. Monitor your investments. Keep track of your investments and review them regularly to make sure they are still in line with your goals and risk tolerance. Rebalance your portfolio if necessary to maintain your desired asset allocation. Be patient. Investing is a long-term strategy, so don't get caught up in short-term fluctuations in the market. Stick to your plan and resist the urge to make impulsive decisions based on emotions. Choose low-cost investments. High fees can eat into your returns over time, so choose investments with low fees and expenses. Index funds and exchange-traded funds, ETFs, are often good options because they have low costs and provide broad market exposure. Here is a practical example. Let's say you want to invest $10,000 in the stock market. You could choose to put all of your money into one stock, but that would be very risky. If the company performs poorly, you could lose a significant portion of your investment. Instead, you could choose to diversify your portfolio by investing in a mix of stocks, bonds, and real estate. For example, you could invest $5,000 in a stock index fund, $2,500 in a bond fund, and $2,500 in a real estate investment trust. Rate. This way, you spread your investment across different asset classes, reducing your risk and increasing your chances of achieving your long-term financial goals. In conclusion, managing your personal finances can be a daunting task, but by creating a budget, saving for emergencies, paying off high-interest debt, investing for the future, and reviewing your insurance coverage, you can achieve financial stability and reach your long-term financial goals. Don't forget to like this video, subscribe to our channel, and leave a comment below with your thoughts and questions. Thank you for watching.